Welcome to FX Options University.
So question here, how did I home in on a $3 strike spread? What I do is when I'm putting together a spread is I look at what are realistic prices. In the case of an index like this, we've got strike prices every dollar, which gives you a lot of choices. If it's unrealistic for this thing to move $5 over the time frame of my spread, then an option that's $5 out of the money is going to be so small and have so little value that the spread can't really be done. I mean, you can only do a spread if both the long leg and the short leg have an actual quoted value. If one leg's at 0 to a nickel, the spread really doesn't work. So I might do a $2 spread, I might do a $3 spread, might even do a dollar spread. It kind of just depends. Mainly it's based on what zone am I targeting, where do I think this thing's going to go, where would I like it to be, and then how wide of a spread is realistic. If I go too wide, the prices get so small on one side or so expensive on the other that it makes the spread not worthwhile. Typically I'm trying to hit a trade that has a reasonable chance of making money without taking on a ridiculous amount of risk. And as I said earlier, most of the time I don't evaluate the merits of a spread based on how much I can make versus how much I can lose. Most of the spreads I do, the potential loss is greater than the potential gain, but the potential gain comes a lot more often, so I don't worry about that. And that's how I decide whether it's a $2 or a $3 spread. It's just a matter of how it lines up. And you can try a number of different ranges of strike prices. When you're trading stocks, if you're trading a really expensive stock like a Google or something like that, you might do a 20 or 30 or even 40-point spread. But if you're trading a low price stock in the $20 to $30 range, the chances are you're going to want to do your spread at $2 or $3 or $5 or less. It just depends on, again, how much value is on the out of the money option. So that's how you decide. Here's a good question. So how many months out do you place your trade? Great question. Really, for almost any option strategy, deciding how far out to go, what expiration to choose, is all about your forecast. The reality is if you're terrible at forecasting stock prices or index levels or where the dollar is going to be relative to one of these currencies, then chances are pretty good if you're lousy at doing that putting on a spread or any other kind of a strategy using options is not going to make you a good trader. It's not going to make you profitable. Ultimately, every strategy you use, whether it's a stock, an index, an ETF, an option, it almost all comes down to your ability through whatever means that might be, whether it's fundamental, technical, in the case of currencies, geopolitical, whatever means it is that you use to decide what your forecast is on where you think something might be at some point in the future. That ultimately is going to determine your success. Now, the type of strategy you use, how much you make and all that can improve your results. It can make your profits larger. It might reduce your risk a little bit. But ultimately, if you just always pick the wrong direction, if you put on bullish trades all the time and things go down, there's probably no way you're going to make money. So your expiration is really all about how comfortable are you on your forecast. I like to use the analogy of the weatherman. I typically say that I keep most of my trades fairly short term, usually a month or two, and that's about it, 1 or 2 months. And it's for this reason. If I ask the weatherman what's the weather going to be tomorrow, he can tell me with fairly good accuracy. But if I say, well, what's the weather going to be a week from tomorrow, well, his ability to be accurate in his forecast goes significantly less. It goes down a lot. In the same manner, I can predict where a stock, an index, a currency, or anything else might be 30 days from now a whole lot better than I can predict where it might be 60 days from now or where it might be 90 days from now. So what I like to do, and this is just my style and it works fairly well for me, is to keep my strategies at usually no more than 2 to 6 to 8 weeks out, and that's it. And it's just because I can do a better job of forecasting where I think the underlying security or index or whatever might be. The closer I keep it, the more accurate my forecast is going to be. So that's what it comes down to. If you're accurate, if you have the ability to do research and forecast 6 months out and be with good accuracy, then by all means put on a trade that goes out 6 months. But I typically try to do it short term. And I'd rather do 3 one-month trades than 1 3-month trade. In a lot of cases, you can make more money that way, and your ability to be accurate in your forecast it goes up a little bit. So question, can the underlying of these options be traded? The answer is no, not technically. What the underlying for these options is an index. And in the same way that you can't actually buy the S&P 500 or the Dow Jones, you can't buy these indexes. These are indexes based on the exchange rate between the dollar and a foreign currency. So you can't actually own an index at all. Now, there are lots of mutual funds, ETFs, and other things in the market, like the spiders. You can own the spiders, and they're a representation of what the S&P 500 is, but they're not the actual S&P 500. In the same way that an index option settles in cash, these options settle in cash. Now, as I said previously, if you own a position in the spot currency, or if you happen to own a futures contract in the spot currency, or that has this same currency pair relationship, then from your perspective of your aggregate position, you might own a put, and you might be married or hedged, but technically from the perspective of the industry and the regulations that we have to abide by in order to calculate margin and things like that, we can't really treat it as a married position or a protected position. We simply have to treat the index as if it's an independent cash settled option. So whatever the result is at expiration, if it's in the money, you pay. You end up. If you own the option long and it's in the money, then you end up getting a credit for however much it's in the money. And if it's out of the money, it expires worthless. If you're short the option and it's in the money, you'll end up with a cash debit to your account at expiration. And if it expires out of the money, then of course it just expires and there's nothing there. But technically, within the same account, it can't actually be covered or married. So here's a question. How do you manage theta when using very short-term options with a few days left to expiration? Well, theta is time decay, and every option has a theta. Hopefully the trading platform you're using, it's similar to Schwab's. It has a real-time calculation of theta or time decay, so you'll know exactly how much value each day these options are losing due to time decay. Time decay is your friend if you're short options. It's your enemy if you're long options. The most important thing to realize about time decay is two things. One, what I just said, and that is that when you sell options short, time decay works in your favor because the options you sell, you actually want to lose value, and time decay will help that happen. But if you're long options, then your options are losing value, and you don't want that to happen. So that's the first important. The second important thing to know about time decay is that it's not the same for options of different strike prices. Options that are at the money, the ones that have a strike price that's closest to the underlying, have the most amount of theta, and they lose time value the fastest in the final month. They have the most amount of theta to give up. Now, that's an important consideration. If you want to buy a long option and your goal is to hold it until it's about to expire, then you're going to want to buy options that are in the money, because in the money options don't have as much time value because the majority of their value is determined by the amount that they're in the money. Out of the money options actually lose time value slower as they approach expiration as well. And the reason for that is because they've actually lost all their value already. If you take an option that's about to expire and it's way out of the money, it has so little value that there's almost no time value for it to give up because it's already virtually worthless. Now, those are important considerations when you're a covered call trader. When you're a long option trader, as in this case, just be aware of the differences. When you're a spread trader, time decay doesn't really hurt you a whole lot because remember, you've got a long option and a short option, and you've got time decay working against you on one leg and working in your favor on the other leg. So time decay actually ends up not being a negative. And in many cases, well, if you think about it, it depends on the kind of spread. So if I was doing a spread where let's say I put on a credit spread, as one of the examples were today, and both of the options were already out of the money, my goal on a credit spread is to have both options expire out of the money. In that case, I want time decay, right? Because the sooner I get to expiration, the sooner those options expire out of the money, the sooner I get to keep my credit, and I know I'm going to get to keep it. On the other hand, if I've got a spread where it's a debit spread and I need both options to get in the money, then time decay is my enemy, because if they're not in the money already, then it's got to get in the money, and I'm running out of time. I need it to happen soon, and the sooner it happens, the better. But if it doesn't happen pretty quick, these options are going to end up expiring worthless, and I'm going to lose everything.
Visit www.fxoptions.com. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.